You have to go back to 2007, the last time we saw the 10-year yield at this point. Now, for those of you that know about the 10-year and ultimately what happened in '07, we remember that the markets topped before the Great Recession. Now, I'm not saying that that's what we're headed towards. What I'm saying is that there's a certain amount of stress that's put on the economic picture or the economy, and when you have higher rates, it means more stress. Things break. We've seen it earlier this year with Silicon Valley Bank, with other banking stocks. Well, guess what? We're now at these levels. If we break above this range, you could be looking at some major breaks in the system, in the financial system.
The sell-off in U.S. government debt continued to hit the world's largest bond market, with yields on benchmark treasuries hitting new 16-year highs as investors come to grips with an economy that refuses to slow. The yield on the 10-year note rose as much as 0.1 percentage points to 4.35%, surpassing a previous high in October and sending it to the highest level since November 2007. The yield was still close to that level in late afternoon trading. Bond yields rise when prices fall. Investors are increasingly looking towards a high-profile gathering of the world's central bank chiefs in Wyoming later this week, where policymakers may signal interest rates must stay higher for an extended period to keep inflation moving lower. Although multiple central bankers will attend the Jackson Hole Conference, Federal Reserve Chair Jay Powell's speech on Friday will be closely scrutinized for additional hints on the pace and future direction of U.S. monetary policy. The months-long sell-off in U.S. Treasuries has been mirrored on the other side of the Atlantic, with yields on 10-year bonds in the UK and Germany recently hitting their highest levels since 2008 and 2011, respectively. Gareth Soloway also referred to the 2007 and 2008 levels, stating that this is the first time they are aligning at the same range again after so many years apart and could be indicative of a very bad omen that could hit the financial system. He also went ahead to discuss the stock market, especially focusing on NVDA, stating that it is still leading the stock market to very high levels. Soloway also shared some analysis on gold and silver and stated that even though silver is doing better now, gold remains a standard hedge for inflation. Let us now get into the video. Also, don't forget to like, subscribe, and drop your comments as you watch.
The other thing to mention is mortgage rates. The 30-year mortgage is now as high as it was going back to 2000. That's the dot-com bubble high. So not only is the 10-year back to '07 levels before the financial crisis, but now you take the 30-year, the mortgage rates, going back to 2000. The other thing I'll mention here real quick, guys, at 10 a.m. this morning, watch for the home sales numbers. I'm very curious. I don't think this is going to be a major mover for the markets, but I am curious to see, with mortgage rates 7 to 8% now on a 30-year, what do the home sales numbers look like? That could be very telling to see if the home data, if the housing market is starting to stall and decline. So watch those numbers at 10 a.m. All right, we have to switch it over to this, guys, right here, all right? So again, we're going to take a look at what we have going on here. And looks like I just tripped over a wire, so nonetheless, we lost one of our screens, but we're okay over here. All right, taking a look here, guys, we see that basically what we have is NVIDIA. Now, NVIDIA has been a rock star, an absolute rock star. And again, what we're seeing this morning is NVIDIA is trading right up here at 481. Now, this is the kicker, guys. We know that this has earnings, all right? There's earnings coming out right tomorrow after the bell. Wednesday at around 4 o'clock, 4 p.m. Eastern time, you're going to get earnings. Now, the kicker is this. We see a very clear channel, right? So channel, lows, 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 and we didn't quite get down there. Then you have the high, high, and high, right? So the idea here is that we're trading at 481, which, by the way, is a double top high. All right, so we're at double top, but if you're looking for your stats on where NVIDIA could go on earnings, this is what it's shaping up to be. Upside is somewhat limited now. So essentially, as NVIDIA stock rallies higher, and we're now talking about a move from about 400 at the lows to now 481. That's a 20% move within less than a week going into earnings. What essentially happens here, folks, is that when we get into a situation where price rallies significantly into earnings, it essentially prices in even better numbers. So, right now we're looking at NVIDIA probably beating estimates, but to justify price action where it is, we are going to have to see them blow away estimates and raise guidance. Otherwise, the stock will likely sell off on earnings. So if we're looking at kind of gauging it to what it could do, your upside is to about $505 right there. Your downside is down to about $400. All right, that gives you that same channel. And again, you have to trust, listen, it's not always the keys here, but ultimately what you have to see is that this channel has held. So as a probability trader, remember, traders in general, most traders fail. In fact, 95% of day traders fail. The reason they fail is because they cannot deal with emotion. All right, emotion ultimately comes out, and that creates a scenario where they do the wrong thing at the wrong time. And in these situations, it makes them do the wrong thing. You have to trust the charts. Now, it doesn't mean the charts are always going to be right. Always remember that. It's a probability basis. So when we're talking about probabilities, a great probability would be 70% success rate. 7 out of 10 winners, you're an all-star. You're a Hall of Famer. You're something like that. So what we're looking at here is when we look at a chart like this, you could say, okay, well, why can't NVIDIA go up here or up here or up here? And the answer is it can, but probability-wise, based on history of this price action, you're probably limiting your upside to here and your downside to right here.
Minutes from the Fed's July meeting, released last week, showed members of the central bank's rate-setting committee saw significant upside risks to inflation, which could require further tightening of monetary policy. A succession of robust economic data over the summer has raised doubts that the Fed will start cutting rates anytime soon and has been a primary reason behind the Treasury market sell-off. Elsewhere on Wall Street, the benchmark S&P 500 closed 0.7% higher following a sharp sell-off last week. The tech-heavy NASDAQ composite gained 1.5%. Shares in NVIDIA, the high-flying chipmaker that is up more than 200% year-to-date, rose 8.5% ahead of its earnings report later this week.
I hear a lot of analysts and a lot of, so-called, traders talking about how breadth has really widened. The answer is no, it hasn't. All right. You still have a stock like NVIDIA leading the market. If you looked yesterday, in fact, let's go to IWM here. We're going to look at the Russell. Okay. Now, the Russell is 2,000 stocks. Okay, look at the chart on the Russell here, guys. And again, I want to show you this because I think it's very, very important to kind of recognize what we're seeing here. So here's your chart of the Russell, and compare it to what you know about the NASDAQ 100, where the NASDAQ 100 went like this, right? So the NASDAQ 100 fell, it then went like this, right? Almost back to the highs. Here you have the Russell, which is a wider berth of stocks, 2,000 stocks. The NASDAQ 100 is 100 stocks, and it's a majority, 50% of it is the Magnificent Seven. And what we clearly see is that, for instance, yesterday, the NASDAQ was up 1.65%, which for the NASDAQ, that's a big move. The Russell was actually negative on the day. So you're not seeing this. And today, by the way, generally the same thing. You're seeing a lot of these stocks, again, NVIDIA leading the charge, getting technology, getting the big name techs. If you look at Microsoft, it's up this morning. If you look at Apple, it's up this morning. Tesla's having a great move today as well. All of these stocks are having big moves. So I do caution you in terms of believing in that narrative that, oh, everything is great because now the rest of the market is playing catch up. It's not playing catch up. And I'll just show you this chart. I'll show you just a couple charts to kind of prove my point here, is that if we look at this chart here, all right, this is Zoom, okay? Now, Zoom reported earnings, okay? Zoom just reported earnings yesterday after the bell. They were actually pretty good earnings, all right? But look at the chart. Look at that, okay? Now, Roku recently reported good earnings, and that one had a good move as well, but look at the chart, okay? Now, let's take a look at, I don't know, Twilio. We could go, I could go on and on, right? I mean, look at these charts. Now, let's go to Apple. Oh, interesting. Look at that. How about NVIDIA, which we just looked at already, right? Look at that. How about Microsoft? Bear with me as I mistyped there. Look at that. All right, so you have charts out there that, again, they're like this, and then maybe they get a little blip over there, and then you have these charts, which are like that. And again, that is not healthy, folks. And what that tells me is that if we do get into a recession and the valuations on these stocks come down, the market's in serious trouble. We have gold at a very pivotal level. All right, so I am long gold. I'm not going to, kid you on that. I'm absolutely long gold. And again, the thought process here is that you have a very beautiful downsloping trend line, pivot point to pivot point to pivot point, and here we are right into that line. We should get a bounce here. This is a triple top, even though I'm only showing two of them. But if we zoom out, we can see the triple top, right? Here's your triple top right here to here to here. The triple tops are shallow pullbacks. They usually break out. The double tops are big pullbacks like that. So big, here's your high, here's your correction, here's your double top, here's your correction, here's your triple top, smaller correction, and usually we get a move to the upside. So just keep that in the back of your mind. So I continue to be bullish on gold. Quickly looking at silver real quick here. If we look at silver, silver's actually performed better than gold in just over the last week or so. And you might say, well, why is silver doing so much better? And the answer is very simple. The optimism for people on the economy is very, very high right now, right? Everyone's thinking it's a soft landing, no landing at all. We're just going to be all good and great. In fact, the Atlanta Fed has GDP at 5.6% for the third quarter. So I mean, even the Fed is saying, hey, listen, this economy's rocking and rolling. I'm a skeptic. I'm not going to lie. I'm a skeptic on that. But the answer is, because silver is more of an industrial metal inclusive of a safety store, this gets a bigger move versus gold has a very small move because the gold trade is more of a safety hedge. Right now, the markets are doing well these last couple days, so gold's not going to do as well. And also, the dollar has stayed relatively strong. If we look at the DXY real quick, the DXY continues to be in this down area here. We can see, again, channel. I do continue to believe the dollar is probably going to pull back. Don't forget, the Federal Reserve, the Jackson Hole meeting is Friday. Well, the meeting starts on Thursday, but Jerome Powell's speech is on Friday at 10:05 a.m. My guess is, and again, this is just me, is that I'm expecting to see a pullback in the dollar based on the channel here. We'll watch very closely, and obviously I'll keep you guys updated.
The outlook for the Chinese economy was dealt another blow on Monday after the latest policy decision by the country's central bank undershot market expectations. The People's Bank of China lowered its one-year loan prime rate, a reference for bank lending, by 10 basis points to 3.45%, but opted to keep the equivalent five-year rate steady at 4.2%. The move was the latest in several policy decisions that have fallen short of expectations, as economists polled by Bloomberg had unanimously projected 0.15 percentage cuts to the one-year and five-year rates. China's benchmark CSI 300 dropped 1.4%, reaching its lowest level since November, while Hong Kong's Hang Seng was down 1.8%. Investor calls for sweeping government support measures come in a time of heightened anxiety over China's economy, which has struggled to regain momentum since the start of the year when it reopened after a prolonged period of strict pandemic lockdowns. Researchers from UBS Investment Bank have downgraded their forecasts for the country's economic growth from 5.2% to 4.8% in 2023, citing a downturn in China's dominant property sector, waning global demand, as well as underwhelming government stimulus measures. The government's policy support has arguably been less than was indicated earlier in the year and less than we expected, said Tao Wang, chief China economist at UBS Investment Research. Recent data releases have signaled that the world's second-largest economy is slipping into deflation, while its exports have dropped and youth unemployment has soared, prompting the government to stop publishing the statistic altogether. European equities made cautious gains on Monday, with the region-wide Stoxx 600 rising less than 0.1%. France's CAC 40 gained 0.5% and Germany's DAX advanced 0.2%. Energy stocks led gainers in Europe after crude oil prices strengthened as OPEC Plus data signaled that global supply was beginning to tighten since Saudi Arabia and Russia lowered exports. What do you think of Soloway's outlook on the present market? Let us know your thoughts in the comments section below. Also, don't forget to like, subscribe, and turn on notifications for future videos. Thanks for watching.